Good day, traders. Welcome back to Traders Watch. Um, this is a community for traders. We just share insights and strategies on the global forex markets. Now, in this video, we're going to discuss the Elliot Wave Theory trading strategy, which is my trading strategy of choice. Okay, so I've taken quite a long time to learn about the Elliott Wave theory, where it comes from, and how you can actually integrate it into your trading to make better trading decisions. So from all my studies on the Elliott Wave theory, I've gathered up a few important things, which I'm just going to try to sum up in this video. And just also tell you guys on how I take my trades and how I view the market. Okay, so one of the earliest mathematicians and scientists from times past have always had these fascinations in looking at the ratios and how things relate to each other, be it in nature or whatsoever. One fascinating result of such study was the building of the pyramids in Egypt. Okay, so it appears as if those mathematicians were so exact as to the ratios and everything that that structure geometrically it holds and it conforms to a lot of natural ratios which can also be found in nature. Okay, so without saying much on that, there is a very important sequence that we should look at first before we go further. And by a sequence, I mean it's just numbers really, one after the other in a specific order or a repetitive manner. Okay, so there is always in nature the question of growth and decay, okay, progress and regress, right? If it's economies, there is booms, there is crashes. All right, this is just a part of the process that go about in our human experience. Okay, this is a part of our psychology. We all think in terms of growth and decay, progress and recess. Even if we are to look at forex markets, which is really just a community of people coming together just for the purpose of participating in trade, right? So what we see is that all this growth and decay, right? For there to be sustainable growth, there can't be just growth that goes up in a straight line. Even if you look at the markets, right? It will never go up in a straight line. Okay, while some people are still buying, some people want to sell, some people want to buy, some people are selling, some are buying, some are selling, some are buying. And so the market appears as though it were chaotic. But this is not the sense. The markets are not chaotic as all. In opposite to that, they are rather systematic. Every trader knows that the market repetitively does some things over and over, time and time again. All right, so one such observation was made by R.N. Ralph Nelson Elliot, right? I gotta give him due respect for this method. This is not my own method. This theory was discovered by Ralph Nelson Elliot. Okay, so he said that if the market doesn't go up in a straight line, and yet if you are to look, maybe if we are to check from this price level to that price level, one can see that really price has just gone up. Okay, but did it go up in a straight line? No, it went up went sideways, jumped up, came down, went up, came down, and went up. Okay, so in as much as it was just going up, it was not going up in a straight line. Okay, and we check, if we check, it has a tendency to repeat the same patterns over and over again. So Ralph Elliot Nelson came up with 13 patterns. Okay, that model each and everything that any market could be doing at any given time. So it is our job in this, when we are using this strategy to trade, we must acquaint ourselves with all the 13 patterns, and we must learn to recognize them when they present themselves in the market, and then we can take advantage of this. All right. So Ralph Elliot went on to say that the market will always move in cycles. Okay. We have bullish cycles where the market will be going up. We have bearish cycles where the market will be going down. The prices will be going down. Okay. And it's easy to also realize that every bullish cycle, right? If we are all agreeing that this was a bullish cycle, when it ends, how will we know that the bullish cycle has come to an end? We must get into a bearish cycle. Then we know that this cycle, the bullish cycle, has completed at this point, because from that point we've had a bearish cycle, right? And after the bearish cycle has completed as well, the market resumes on a bullish cycle, right? And then a bearish cycle, and then a bullish cycle, and then a bearish cycle. But does this go on and on and on again? Actually, no. But what happens is there is a systematic way of how the market does this. Okay, so remember, you can be viewing the charts at the 1 minute time frame. You can be viewing the charts at a 5 minute. You can be viewing at a 15 minute. You can be on the 1 hour. You can be on the 4 hourly. You can be on the 1 daily, or you can be on the 1 monthly time frame. But even whichever time frame that you're going to be looking at the markets, these patterns are not going to change. You're still going to see the same patterns. You're still going to see the same cycles. Okay, the only difference that will then come would be on the issue of degree. Okay, so in as much as the patterns are going to have the same look, they're going to look the same, they're going to have the same rules, but the degree will be different depending on which one is the bigger movement. You obviously can't compare, if we are to look at this chart right here. Okay, in as much as this is a bullish cycle, right? In terms of degree, you can't compare to this bullish cycle here. This is obviously a bullish cycle of a smaller degree compared to this one. If you check, this spans over a large range of prices than this move here. The same with this bullish cycle here. But if you check, this bullish cycle and this bullish cycle seem to be in the same degree. Why? Because their sizes appear to be the same. But what about if you compare this bearish cycle here with this bearish cycle here? Okay. Now, we don't need to be using our naked eyes to see this. That's why we have the Elliot Wave Theory and the strategy, which we are just about to get into right now. Okay. So to begin with, Elliot said that at the first laying foundation for this strategy, the market never moves in a straight line. So if we have a bullish sequence, we are bound at some point to have a bearish sequence, right? But how far back is this bearish sequence going to retrace, right? It depends with the overall market direction. Now, if the market is pushing for upside on the larger degree, right? If it's a larger degree bullish cycle and the bullish cycle has not yet completed, this will not typically retrace more than 61.8% of the original move. So you would typically expect this to come within 50% to 61.8% of the original move, right? And then after that, you will have then another bullish cycle, right? Which is going to, in terms of price movement, it should be more than this. It should be a multiple of this, right? But how far will this typically go up to? It should typically go up to 1.618% of the original move. Let's say we've labeled this our wave 1, right? This being our wave 2. So your wave 3, which is the third wave in the bullish cycle, your wave 3 will typically go up to 1.618% of the first wave. And how do you calculate how far this has gone? Okay, by simply using the trend-based, the Fibonacci extension tool. You click on the start of the wave, you click on the end of wave 1, and then where your wave 3 is supposed to start. Let me do this. Okay. Let me use red. All right. So yeah, I was using freehand, but you see it came quite close because always these waves must have the right look. Okay. It has to look something like this pattern that you see here. Then you know that it's an impulse. If it has a different look, then you should probably consider labeling that pattern differently. Okay. So there now we have our wave 3. Next, after the bullish cycle is complete, we should then expect our bearish cycle, right? And this cycle is going to be a retracement of the wave 3, okay? So we have our wave 4 there, but how far back should wave 4 retrace? So typically, according to the Elliot Wave Theory, this wave here should retrace typically not more than 38.2%, typically not more than 38.2% of wave 3. So if you pull your Fibonacci from the beginning of wave 3 right up to the end of wave 3, you would expect that your wave 4 will terminate around the 0.382% of wave 3, right? Let's have that level also, 38.2% of wave 3. That's where you will typically have your wave 4, right? And then the theory goes on to say that after a wave 1, wave 2, wave 3, wave 4, the bullish cycle will still not be complete. You can have another wave, which is the final wave in an impulse. This should be your wave 5, right? Now, at this point, we say that the bullish cycle has ended. Remember, in the simplest expression of the Elliot Wave Theory, we only need 2 lines where we just have an impulse and a correction. This is the simplest expression of the theory, okay? But and this comes from the Fibonacci, sequence. Maybe I should just write the sequence down just so we can see what the sequence looks like. Okay, I'm only gonna need these. These are the first numbers of the sequence. So what you do, you just add the previous number to the previous number to get the next number. So here, if you add 1 and 1, you get 2. If you get 2 and 1, you get 3. If you get 2 and 3, you get 5. If you add 3 and 5, you get 8, and so on, and so on, and so on, right? So in the simplest expression of the Elliott wave theory, you only need 1 bullish cycle, one bearish cycle, and together they're gonna make two waves, which is, this is a Fibonacci number, and the two waves together will be a complete cycle, right? If you are to make this more complicated, or if you want to zoom into this big structure, right, you're gonna need three waves for the bearish cycle, or whichever is the smaller cycle of the two. Remember, this is all about growth and decay. So if we are growing, obviously the one that is pushing the move has the more waves. So that means an impulse should have a 5 followed by a 3 waves correction, right? If this was 1, 2, 3, 4, 5, which is what we have here, should be followed by a 3 wave correction. Together you have 8 waves, and the 8 is a complete cycle, and so on and so on and so on. Okay. All right, guys. So we've had a 5-wave swing to the upside. Now our bullish cycle has completed, and this is a 5-wave move. 1, wave 2, wave 3, wave 4, and a wave 5. Remember, this is the simplest way that the market can express itself in an impulsive move. Now, what we would expect to complete this cycle, we should have a 1, 2, and 3 wave pullback, typically retracing, depending on where this cycle falls on the larger time frame. This could typically retrace between 50 and 61.8% of this original move. And you'll find that all these levels are Fibonacci levels. Okay, so if it's a correction, we use letters to denote a correction. And a simplest expression of a correction would be an A, B, and a C structure. Okay, I should probably use capital letters there. So we have an A, B, and a C. Now that's a complete cycle with 13 waves, 13 mono waves. Okay. How is this useful for trading? How do you use this to trade? Okay, suppose you are observing the market and you do realize that you are in what appears to be a bullish trend. What you're simply going to do is to count the waves applying all the Elliot wave principles and rules. Okay, so if at this point here you anticipate that the market should make a move to the upside, or you want to buy into this impulse here, maybe say you have caught it at wave 2. All right, so what you do, you put your invalidation levels. You know that if you are buying into this, your market should never go beyond the start of the wave 3. So if you're buying here, this is obviously going to be your stop loss. Now you would want to count the internal waves of this your wave 3. Obviously, it's also an impulse. It is supposed to have 1, 2, 3, 4, and 5 waves. Okay, so you have a chance to trade this wave at this point. You can enter the market. You can also enter the market at this point, right? And if you have been long from this level here, if you are holding on to your longs, you know that your wave 4 is simply a correction to this swing, and it should come to 38.2% of the whole swing. So there's no need to start panicking when the market starts to retrace in 3 waves. All it's just doing is giving you another opportunity to enter and you can take your trade higher again until you get to wave 5. This can be even your final take profit target. But if because these 5 waves, in the same way that the wave 1 here subdivides into 5 waves, all these 5 waves can be as well a part of a larger degree 1. Okay, this can be a 1 in the super cycle, and this can be a wave 2 in the super cycle, and a wave, then we can expect a wave 3 going forward, and the process goes on and on and on. Okay, so you just need to recognize your impulses, which are the easiest to recognize, because every time the market moves impulsively, there will be a huge shift in prices. Sometimes you find price moving and even creating gaps in between. You know, you're in a very impulsive market. And then we also have the corrections. Okay, now most of the patterns that we are going to look at are corrective patterns, and for some reason the corrections are not as easy to decipher as the impulses, and yet for more than 80% of the time the market is in a corrective phase. So impulses only cater for less than 20% of price action. It's only less than impulses take a very short time to complete, while corrections tend to be more sideways and taking up more time. Okay, but the market moves a lot, and there is a lot of nice trades that you can be participating in if you can anticipate the market well in advance. If, for instance, you know that your market is now in this corrective phase, you have had your leg A, and then you have a pullback in 3 waves completing this B. Right at the end of this wave B here, you can take a trade to the downside, right, to trade this whole of wave C here. Okay, so let's just get into the patterns cheat sheet, and I'll just try to give you guys all the patterns that we have in the Elliot wave theory in their simplest expression. So if we have an impulse, right, the first one we are going to talk about is the zigzag. This is very common in the market. We can have a zigzag. Now, a zigzag looks, this is what a zigzag looks like. So it's a very sharp counter trend movement that looks something like that. Should I use black? Should I use black there? So it's a counter trend movement that's sharp. That's what a zigzag looks like. And at the end of the zigzag, the market will then resume the trend. Now, likewise, there is some rules to this. This is your A. This is your, let me use the proper color. So this is your A. This is your B. And that's your C. Okay. So normally what the market does, your B would normally retrace between 50 to 61.8% of wave A. So that's your 50 to 61.8% of wave A, right? And then your wave C can be anything between 1 to 1.618% of wave A. Okay, so this, most of the times the market likes to take it to equal legs. So if you have this leg here and you have a connector in between, right, the market will typically go to equal legs before it changes direction or before it resumes the direction of the trend. Now this here, all these levels here are very powerful in anticipating the market and setting up a trade. You will see when we look at a proper chart, like trying to identify these patterns on a proper chart. Now, besides the zigzag, we also have one other common pattern, one of Elliot Wave's patterns. So this is pattern number 1. Pattern number 2 is a flat correction. Now, a flat typically looks like this. We can have a swing in that direction. Then the correction would typically look something like that, right? So it has the look of a flat. That's why it's called a flat correction. It has the look of a flat before the market can then resume the original trend, right? Again, this is also labeled, this is an ABC corrective structure. We are going to look at the internals of these waves. We are just, right now, we are just looking at the simplest expressions, just like we know that an impulse is made out of 5 waves, but we are not showing these 5 waves for now. We are just showing it as the simplest way this pattern can express itself. Okay, so we just have 1 wave, and then the 3 waves for the correction here are in that manner there, and then we have another impulse. Okay, so there is really no guideline on the A, but typically for you to have the right look of a flat correction, you want your B wave to retrace at least 90% of A, right? And then on a flat correction, your C would normally go up to right at the start of your wave A. So this is typically 100% of A. Then it has that look of a flat, right? So this is a regular flat. You can have 2 types of irregular flats. One is the expanding flat, the other one is the running flat. So we are going to start with the expanding flat. The expanding flat, we have our impulse there. Okay, so the expanding flat will typically have our A, right? And then our wave B is going to break this top here, and then our wave C is also going to break the bottom, right? And then after this correction, we typically have a resumption in the direction of the trend. Okay, so this would be here our wave A, this would be our wave B, and that would be our wave C. And it should have that look of an expanding triangle. Okay, now there are really not much guidelines as to the Fib levels of an expanding flat. But wave C typically comes down to 1.618% extension of your wave A. Okay. All right. Now, one thing we haven't mentioned is the number of subdivisions that are allowed per correction. So I'm going to start with the zigzag before we proceed to the other patterns as well. I feel like we should do this at this point. Okay, so remember, an impulse can subdivide into 5 waves. Or we are also allowed to have subdivisions in a zigzag or a flat or an expanding flat, but the subdivisions should always be wave A can either be 5 waves or it can be 3 waves, right? For this case, let's have 5 waves, 1, 2, 3, 4, 5, right? But wave B can only subdivide into 3 waves because it's a correction to this swing. And then our wave C can also be 5 waves. So that's the internal structure of a zigzag. It's a 5, 3, 5 corrective structure, which means it has 5 waves, 3 waves, and 5 waves. Then we can label it an ABC. Anything without this subdivision of internal waves here, you can't label it a 535. Otherwise, it becomes something else. Okay. Now on the regular flat, the regular flat can be a 3, 3, and a 5 corrective structure, which means wave A has 3 waves, wave B has 3 waves, and then your wave C is supposed to have 5 waves like that. So we have a 3, 3, 5 corrective structure, and the labeling is simply an ABC. The name of the structure is a flat. All right. We go on to the third one, which is the expanding flat. This one is also a 3, 3, and 5 corrective structure. Okay, so this is also a 3, 3, 5 corrective structure, and the labeling is an A, B, C. If the structure internally is not a 3, 3, 5, maybe you find it's a 3, 3, and maybe 3 waves here. You can't label it as an A, B, C, but rather you label it as something else, and we are going to get into that shortly. Okay, I would like to look at the running flat. I'm just gonna remove this just to create more space. Okay, now your running flat corrects in the direction of the trend. What do I mean by this? You have an impulse. Now, this should be the first leg of the correction. Your B leg is going to break the top, but your C leg will fail to break the bottom. So it has that look of a running flat and then resumption of the trend. Okay. So it has that look of a running flat. It breaks the top, fails to break the bottom. And internally, it should be a 3, a 3, and a 5. All right, and the labeling of this structure is an A, B, and a C. Okay. Next, we are going to look at, so we've looked at 4 patterns so far. We also have triangles. Now, triangle corrections are where the market will be going sideways, right? So if we had an impulse, the correction would be made, all these other corrections were 3 waves, but on a triangle, that's the only corrective pattern that has 5 waves. So you can have an A, a B, a C, a D, and an E before the market resumes the move to the upside. So this, you label it as an A, a B, a C, a D, and an E. But an additional guideline on this structure is that it is only allowed to have just one impulse. Okay, so you can't have more than one impulses within a triangle. Otherwise, it becomes something else. So let's say our A is the impulsive wave, F5. That means these other ones here need to be 3, 3, 3, 3 corrective structures. That's your triangle. So this triangle, I'm not gonna look at all the types of triangles there is like we did with the flat corrections. This is a running flat. And this is a triangle. Now, I'm not going to look at all the types or all the variations of the triangle, but we can have a contracting triangle, which would look something like this, right? So the correction would typically, so 1, 2, 3, 4, and 5 before the market resumes that direction. Okay, so it has a flat bottom, a flat top, ascending bottom. We can have that in reverse. We can have a triangle. Let me clear this. We can have a flat bottom, descending top. It's also a triangle. So if it's like that, then the market can correct in that manner there. 1, 2, 3, 4, and 5 before a resumption of the move to the upside, right? We can have an expanding triangle, which would look quite the opposite of that. And after a swing, the market can give you 1, 2, 3, 4, and 5 before resuming the trend to the upside. Okay. So those are the patterns. Those are the patterns. The other ones are just variations of this pattern and all the other patterns that we've already spoken about. Now, next, I want us to look at what the market normally loves to do, which is creating complex corrections. The market loves from time to time to create complex corrections. Okay, so I was watching this trade on gold since morning. If you guys can see just what we were talking about now, I'm very happy this is playing out now during this recording of this video. If you check, we had what appeared to be an impulsive move. If I may show you. So the market has been impulsive overall, right? We can't be sure if we are in wave 1, wave 2, or wave 3, but this has been overall an impulsive market. But if you check after this impulse here, we had this impulse here, right? And then we had a correction. 1, 2, 3 waves, right? This looks like a flat correction to me. And then after that, we had another impulse, right? And then we had a correction in 3 waves, 1, 2, 3, right? Now look right here at the end of this correction, we seem to be having a reaction to the upside, marking the end of this corrective phase here. Now the market is ready to push to the upside again, okay? So if we had placed a trade around this level, let's just check, can I zoom in there? Just to demonstrate something. Okay, so this was our 3-wave correction. Let's zoom it down to the 1 hourly time frame. Okay, it's more clear on the 1 hourly time frame. So we can see that from this peak here, the market came down in what appears to be 1, 2, 3 waves, right? Went up in 3 waves, which is the combination corrections that we are just about to look at. Now it also came back again in 3 waves, right? But in the larger degree, in a 1 degree larger than this one, it will just simply have made 1, 2, and 3 waves to the downside. If anyone can tell what corrective structure this is a zigzag. It has the look of a zigzag, but do we label it ABC? We said for an ABC, it must be a 535. This appears to be a 333. Okay, how do you label that? Which is also what we are about to look at next. I just wanted to show you guys that at the end of this correction, now we have this impulse coming, okay? So the Elliot wave always delivers everything that it promises, everything that it promises, okay? And the level of accuracy for this analysis too is on another level. If we check our Fibonacci levels here, okay, we said typically you typically want your C leg or the last leg of a 3-wave correction to come to at least between 1% to 0.618%. So let's see about this wave. Let's just check. Let's check. Let's check. So it just misses this by a few pips. This is quite disappointing, really. The market didn't come to the 1%. So it could be two things. Either this correction has not yet ended, right? That's the only thing that this thing can mean by now. So we've had, okay. So instead of just jumping into the trade because the market is going up, you then want to wait and check with your Fib levels and see if it's what it appears to be. So if we check, we had one swing to the upside, okay? So if this was the end of wave B, we are still going to Fib that and see if that's the end of wave B. But I know that my wave should come from between 100% of the first swing, at least normally up to here. But this is the invalidation level. I don't want to see my wave to trade lower than this, okay? So if I'm entering this trade, this here would be where I put my stop loss. Okay, so what I see here is the market went up in 3, came down in 3. It can go up in 5 waves or 3 waves just to complete this cycle here in the middle. Let me use the proper colors, proper colors, proper colors. Let's say that was a swing in the yellow degree, right? So 1 degree lower than yellow, I'm going to use the green degree. That's that degree there, right? And then finally, we should expect the market to come down and enter the area of the blue box. Okay, so this is the power of knowing those Fibonacci levels. Now you can predict the market and anticipate that it's going to come to a certain level even long before it comes to that stage. Okay, so this is where we're going to put our blue box. And I normally like to draw my blue box so that it covers this whole area here. Why do I do that? So that I will know exactly where to put my entry. This is my entry level there, right at this quote here. I place a buy limit at this level, and then you put your stop loss at that level there. This is where you want to place your stop loss, right? And just kind of let the market run and watch. So if you didn't have the Elliott wave count, it would be very easy to be trapped in this kind of market and think that now the market is going all the way up, only to see it come up to this around these levels and then drop down massively. Okay, but if you understand the cycles and the sequences and the degrees, you will know that for this cycle to be complete, if this is a zigzag, if this was a zigzag, right, it should terminate at least anywhere between 1%, 100%, and the 1.38%. So far, it has just terminated at the 0.618% level. All right. So that was just a minor distraction there. I saw that candle and I thought, oh my God, gold is going up. So this one in the middle can even play out to be an expanding flat correction because it has broken the bottom. It could come up and take the top, but still will not take. This would be an invalidation level, and then before dropping down again. Okay. So enough about that. Let's talk about combination corrections. Okay, combinations. So this is what happens with combination corrections. They are very common in the market. So remember we said if we had an impulse, right? And then after the impulse, we had a 3-wave correction. The market should resume back in that direction. But what do you realize? Remember, we said this should come up to maybe the area, anything from 38.2%, right, for wave 4 of any correction, up to 61.8%. This is still a nice correction, right? But what happens if this is not even 38.2, it's less than 38.2%. So obviously after such a big move, you wouldn't expect the market to give you such a small correction and then resume again, right? So the market is in the habit of forming complex corrections, all right? So in the minor degree or in the smaller time frames, these corrections are going to appear very complex, but if you view it from the larger degrees or the larger time frames, it can be very clear what the market is doing, okay? So if we have these 3 waves, we can, instead of having 5 waves, we can have another 3 waves going up, which is a corrective wave. It's not an impulsive. We said an impulse should have 5 waves. And then after 3 waves, we can have again another 3 waves, okay? So if you look at this correction here, this is a complex correction, right? But the market loves to do this, okay? Because the market will just be treating the whole of this as one wave. It will be treating the whole of this as one wave. It will be treating the whole of this as one wave, okay? So there you have your 3-wave correction, but the correction subdivides to a 3-3-3 structure. Now, this structure is not a zigzag. Remember, we said a zigzag is a 5-3-5 structure, which we can label an ABC. But if the market gives you something like this, then you can label this a W. This becomes your connector X, and this becomes your Y, okay? So the Fib levels for such a correction, and these are very profitable trades to be trading. Like if the market just gives you a 1, 2, 3 like that, okay, the confidence to trade this, I normally love it when the market comes down correctively, gives me a connector in X, and then completes the correction. It gives me a better entry to the market. Okay, so this one normally retraces up to between 50 to 61.8% of wave W, right? And then your Y leg will always be between 1 and 1.618%. Okay, and this will be your blue box area. You want to position yourself here for a trade. So if this is the 1%, you want to put 2% of your trading account here as an entry, and then your stop loss right at the 1.618%, that will be the invalidation. So this is your entry. This is your stop loss. Okay. So besides this symbol, this is a double correction, by the way, and your W can be any of the 3 wave structures that we discussed, which means it can be a zigzag, it can be a flat, right? It can be a leading diagonal, it can be an impulse. It can't be an impulse, sorry. It has to be a 3-wave move. The same applies to your X, the same applies to your Y. So it can be any combination of the valid Elliott structures that we spoke about. Now, the last combination structure that we're going to talk about is when a market gives you a 3, goes back up in 3, comes back down in 3, goes back up in 3, comes down in 3. Now, this is an almost guaranteed trade, okay? This is very rare. This is very rare for a market to correct like this. But if you are counting your waves right, and you have had your W, you've had your X, you've had your Y, instead of the market going up, it gives you another X and then a Z. Okay, so the market can only have three combinations of corrections. So this leg, that leg, and that leg. This is normally called by advanced Elliot traders an 11 swing sequence. Okay, so an 11 swing sequence. This is an almost guaranteed trade. If I ever come across this in the market, I can even put 10 lot sizes on this one. These are the money trades, okay? So normally the market just gives you a double. It's single corrections really, they are never the end of a corrective cycle. Normally the market will give you a double, and on rare corrections you can get the triples. But that's all there is to the Elliott wave theory and the patterns and the structure and the basic rules. I know I've omitted a lot of the rules and the guidelines on this structure. Elliot actually wrote a whole book, and there's a book by Robert Prester and AJ Frost. AJ Frost and Prester on the Elliott wave principle. I don't know if I've spelled that word right, but this textbook, I found it to be very, very informative on the rules and the guidelines of each of all these structures that we've discussed about. And it makes it even more easy to identify these structures within the market. Okay, now just to close up this video, I want us to go into a live chat on gold, a live chat on gold. Okay, so it seems out like that structure is playing out just how I predicted. Okay, because I'm expecting the market to give us a structure like this, so that it comes to the 1%, 100%, sorry, so that it comes between 100% to 1.618%, right? And you can take the trade like that. Okay. That's the beauty of knowing the structures and the direction of the market. You would have already positioned yourself for the trade here. So when the market comes here, this is a very, very psychological level. You always, almost 100% of the time, you get a reaction from the blue box. Now, it can be a reaction in 5 waves, and then you would have caught a very good trade, or it can be just a reaction in 3 waves. So normally at the equal legs, if you get one leg up, a correction, when this third leg here gets to equal legs to this other first one, you want to move your stop loss to break even, right? Why do you do that? So that if it's not a 5 wave reaction, perhaps the market will come down again and take you at a loss. Now, if it ever retraces back up to equal legs of here, you want to move your stop loss and put it here. And even if it continues to do that, you would have already entered the trade risk-free. Okay. Now we shall look at the structure of gold. So when you're analyzing any naked market, when you're looking at any market, you want to do your top-down analysis. What do I mean? You want to start from all the information that you have on that market, all the information that you have on that market. So this is my gold monthly chart. As you can see, it's quite detailed. It starts from 1834 there, around 1834 there, right up to date. Okay. So while I'm looking at that, and with all the knowledge that I have so far on the Elliott wave principles, from these laws of 1972 up to this peak, or rather, let's use that peak there, the market appears to have been in a bullish cycle, right? So this must be an impulsive move. How do I count the waves? I can see an impulse here. I can see a corrective phase there. I can see another impulse there, right? I can see what appears to be a correction there. Another impulse. Okay, so how do we label this? How do we get into the structures and the sequences? So this can be a possible wave 1, right? And this can be a possible wave 2, right? But is this the end of wave 3, as wave 3 ended here? One way to find out, we go to our fibs, right? Let's do the fib extension from the start of wave 1, end of wave 1, to the start of our proposed wave 3. So wave 3 should end at around 61.8%. And looking at this is already at the 61.8%. So one can say that, okay, so my wave 3 has ended here, and then label this as a wave 3. It's still allowed by the Elliot wave principle or the theory. Okay. Now we might want to zoom in. We want to zoom in. So we've said this is a wave 1, this is a wave 2, that's a wave 3. Okay. All right. So we have so far a wave 1, a wave 2, a wave 3, and a wave 4. The rule for wave 4 is that it should not come to the territory of wave 1. And so far, this wave 4 here doesn't come to the territory of wave 1. Our wave 3 is at 1.61. Actually, it's above 1.618% extension of wave 1. So this is a valid count so far. No invalidations yet. Our only invalidation level so far is this line here. The price, if the price trades below this line, then we have invalidated our count. So now whatever the market is doing now, obviously this is our wave 5, according to this count that we have so far, okay? And now what we do is we want to zoom into the wave 5 and see how the wave 5 itself is unfolding, right? So we are in an impulsive wave. We know that wave 5 is the last wave in an impulsive sequence. Okay. So if we look at this, wave, one could say that we are having what appears to be wave 1, wave 2. Can I use black there, which is more visible? So we have wave 1, we have wave 2, right? That's good so far. Also, this appears to be impulsive. Another wave 1, perhaps. So we have wave 1, wave 2. The wave 3 should go there up to 1.61.8% extension. Now we have wave 1, wave 2. Okay, this appears to be wave 3. Inside the wave 3, remember this is wave 1, this is wave 2, right? In a smaller degree. And our wave 3 is going to end somewhere there. Now within the wave 3, we have also wave 1. Let me use red. We have wave 1, we have wave 2. Now our wave 3 could possibly have ended there. Now all of this should be our wave 4. Now how is that wave 4 playing out? When we finish our wave 4, we have 5, which should be the end of this wave 3. Now we would have a bigger 4 and then a 5. And that will mark the end of this whole cycle, this whole bullish cycle. And we'll see gold to start to drop and give us a bigger corrective phase. So the bullish phase would have ended for gold. Now we'll get now into the bearish cycle. Okay. All right, so what I'm just gonna do, we are just gonna zoom in to this wave 4 because already we have 1, 2, right? And we are still completing wave 3 here, right? But within wave 3 itself, we have an internal count of, we have a 1, 2, 3. We are currently completing wave 4 for a wave 5. I think now you guys can see how this can be interesting. And if you know how to count the waves, the cycles, and the sequence, you have no idea, you can't imagine the amount of capital gain that you can have just trading in the direction of the market, okay? Just knowing how to count the waves properly. Okay, so remember right here at the top, I've just zoomed into the 1 daily chart. Remember right here at the top, this is where we propose that our wave 3 within the larger degree wave 3 is ended, and this is our wave 4. Can we say our wave 4 has ended here? Well, if that be the case, then we're supposed to see an impulsive move going up. But does this look impulsive? This looks very corrective. The market is just grinding in this range here. So what I see as a trained Elliot waver, someone who knows their Elliot wave patterns, I see the market to have come down here with a swing, right? We are going to look at the internals of that swing and see if it was impulsive or corrective or how many waves it has, right? And then to correct that, the market gave us one swing like that, right? And then after that, the market came back down again in 3 waves like that, right? And then after that swing, now the market seems to be going sideways, right? Because we have, let me use a lesser degree again. We have what appears to be 3 waves up, right? We have what appears to be another 3 waves down. Now we have this move here, which appears to have been 3 waves. Could this move here be completing this cycle here, right? And then after that, we're going to expect this cycle to complete, giving us a pattern like that. And then after that, we're going to expect this cycle to complete, giving us something like that, right? And then finally, we are going to complete this cycle here and give our wave 4 somewhere there. Now, this is just a long-term focus on gold, just depending on the, just basing on the cycles and the sequence. So after this, we would expect for the original trend to resume, to complete the wave 5 on gold in the grand super cycle. This is a very large cycle. Okay, but these small moves, you find that they are always a lot of pips, and you can trade this. You can trade this. This move alone is over 19,813 pips. So as you can see, this is a lot of money. All right. So if we are to look at this our wave 4 here, this is my focus, just what I'm seeing here. I can see 3 waves up. Maybe let's label the internals as well. So I see here 1, 2, 3 waves, right? And then the market appears to have come down in 3 waves. Now it's going up in what appears to be very impulsive, 5 waves, right? So this is a 3, 3, 5, which can be an A, a B, and a C corrective structure in the purple degree. And then here, what we see also internally, we have 1, 2, 3 waves coming down, right? I would also expect another 1, 2, 3 waves coming down. Now, this would be a 3, 3, 3 corrective structure in the yellow degree. So it would be labeled a W, an X, and a Y. This is a larger degree, right? And then after completing this, what we'll then have would be, let's see how many waves we can count on that swing here. I see what appears to be a running flat here in the middle, an impulse on one side, and impulse on one side. So this would be 1, 2, and 3 waves. So we have 3, another 3, right? This cycle here, this red cycle here. This is 1, that's 2, that's 3. And then we can also expect another 3 waves coming down like this to make, in the larger degree, the red degree, a W, an X, and a Y. So this Y leg would mark the completion of your wave 4 in the green minute degree wave 3, right? Which is just completing this wave 3 here. Okay, so let's see if we can look for any short-term setups on gold. Okay, so this is the labeling that I have here. Let me just go down to the 4-hourly chart. Okay, so this is my whole wave 4 playing out. That one we have just looked at now. Okay, and like I've already indicated, I see a 3-wave move here, 1, 2, and 3, right? And then this is also a 3-wave move, 1, 2, and 3, right? This looks like an A, B, C structure. This looks like 3, 3, 3, but this is impulsive, so A, B, and C, right? And then as a connector, we have 3 different degree, 1, 2, 3, right? This is also an A, B, C, but altogether what I see here is just 3 waves, 1, 2, and 3 waves coming down on gold. Now this is a large degree move. You can't compare this whole swing here, these 3 waves, even if there's 5 waves here, but you can see that this is a smaller degree, way smaller than this one. This is just 3 waves, but in the large degree. Now, if it's a 3-wave move, it can either be our A, right? Or it can be a W. Either way, we don't care. It's a correction, so it must be 3 waves, right? So after a W or A, whatever is coming after should be our B, right? We are now looking for the wave B or the wave X. Okay, now we need to find the end of wave B or wave X. You find that the exercise on Elliot wave counting is just to find where the one swing starts, where one swing ends, and where to anticipate the next big move and positioning yourself likewise. Okay, so looking at this has been very impulsive, 5 waves, right? But this is a clear 3 waves, right? Coming down, this is also a clear 3 waves going up. Okay, but have we completed this degree yet? Because if this degree is complete, we should have 1, a 2, we expect to see a 3. But what is the market doing now? Let's get right into it. So at 1 degree less than the yellow, I'm going to use red degree there, right? We have this swing here, right? If this is our correction, this swing, I expect to see another move in its degree in the opposite direction. And then I expect to see another move in the opposite direction to complete the sequence, okay? But what I see here is a 3-wave move to the downside, similar in size to this. No, it's 1 degree less as well, because if it's going to be similar, we just represent it with 1 swing there. But internally, this has 3 waves. Internally, this could be 1, 2, maybe 3, 4, possible 5 there. Impulsive, pretty impulsive, right? Now, the next swing that we have is gonna be this swing here. It's gonna be this swing here, which is also a 3-wave up move, 1, 2, and 3. Okay, so now so far we have 1, we have 2. Are we going to complete this sequence here by another leg to the downside? Now the market doesn't seem to suggest so. We have what appears to be 1, 2, 3, 4, 5 waves there, right? Pretty impulsive, but at a very lesser degree than this move here. Now after these 3 down, we have now what appears to have been 1, 2, 3, which can be a 1 wave. This can be 1 wave, right? And we also have 1, 2, 3 waves, which can be another 1 wave. Now we have this, which appears to be very impulsive, right? Which can be the C leg of an ABC correction, right? So this could be an A, a B, a C. Those are 3 waves, right? This here in between, this whole swing from here to there, right, can be a 3-wave swing. So what I'm looking at here is we came down in 3 waves, we went up in 3 waves. Okay, what 3 waves am I talking about? We came down in 3 waves. Now we are going up in 3 waves. 1, wave 2, and wave 3. Okay, so when we finish this, right, we can expect the market to drop at least 2 equal legs of this move here. So we can have this move coming down in 3 waves just to complete this cycle, right? Just to complete this cycle, 1, 2, 3, right? And then after that, the market can just keep dropping. Maybe this is, so this here, at this point here, this could be the end of your wave B or your wave X, right? Not here at this point here. So your wave B or your X could be there. And then finally, you can expect this to run all the way and give you your Y, right? If not, the market can be sideways for quite some time. What we know is after we have this as the same degree as that move, if this move here is going to be the same degree as that move there, right? What we can expect for is another wave to complete this degree here, because remember we have another degree here, this degree here. We can then expect a move similar in size to that one, right? But after that, that would be the last, because now this whole correction would have been a complete cycle. Now we can look forward for this degree here to come. And okay, so these are the money trades, guys. These are the money trades. Now, as Elliot Wave traders, you want to keep on your toes, trying to anticipate this turning point. You want to try and anticipate this turning point for a trade to the upside. You want to try and anticipate this turning point, okay? If you catch yourself successfully one of these moves, these are one of the money trades. Once you get short at this point here, you just hold on and ride the whole trend up to here. And these will be thousands and thousands of pips. Okay, so I'm not gonna go down to the 1 hourly just to check on the one swing, on the last swing there on gold, but I want to assure you guys that now we are just doing the final, the 5th wave here. We are really, what we are just doing, this is a wave 4 on the final leg. I'm just expecting one more leg to the upside to complete this 3-wave move here. Whichever way one looks at it, some can say A, B, C. Someone can even say this is an A, that's your B, and this is a C. Either way, I know that my C cannot and should not exceed the 1.618%. Otherwise, that invalidates this whole structure. I have to get a new different count or start to view this whole swing as an impulse. Okay, and you must always be dynamic in your count. In fact, at any given point, you must have the count that you favor, but you must also have an alternative count, which you will take in the event that your primary count has been invalidated. That's all that Elliot waivers do. Okay. So if you remember at the beginning of the class, somewhere in the middle there, we were looking at the price action of gold. And I told you guys what I was expecting. Maybe just before we close, we can just look at that. Okay, so it can be easy for the market to fool you if you are not paying attention. But if you are paying attention and you have seen this huge drop here, right? You have seen that huge drop there. Okay, and then the market just does this one, sorry, it just gives you 1, 2, 3 like that. Okay, and then you can't, after these 3, then it gives you again these are the 3 waves, 1, 2, 3. So you have 5 waves, you have your 3 waves. Okay, so these are 3 waves, 1, 2, 3, right? And then you get these 3 and those 3, then you're already like, no, this is a zigzag correction. But we know the rules of a zigzag. A zigzag, should that C leg should retrace between 100% to 1.38.2%, 138.2, sorry, to 138.2% of the leg A. So this cycle is not yet complete, guys, right? So like I told you, what I'm anticipating here, just by looking at the structure alone, is that the market is going to have this complex X wave here, or complex B wave, whichever the case is going to be, so that this is a swing, right, in a W or an A, right? And then this now here would be my X or B. So you can count A, B, C, depending on the move that is going to come here. This will determine which structure levels I'm gonna go with, right? If it's impulsive, then this is gonna be a C. Remember your 3, 3, 5. But if it is also made up of 3 waves, like this one here, this one we can all see that it has been just 1, 2, 3 waves, right? So if we have another 3 waves here, that means the whole move would have been a W, X, and Y structure. So you can't have a C leg with 3 waves. So we would have to take away or do away with that count and remain with this count. But for now, the focus still remains. If you want to enter short-term positions on gold right now, you would look for short-term sells, right? As soon as this structure completes here, 1, 2, 3, you want to look to sell to the downside. Okay, now I normally don't go to the 15-minute chart or the 1-minute chart, but just to demonstrate that the Elliott wave, it works on all the time frames. It works on all the time frames. So this is the 15-minute chart. The structures are more clearer here. Okay, so on the 15-minute chart, we see the 3 waves up that we've just spoken about, and these are the 3 waves down, the large move here, right? So now if you check, we have these connectors here. So 1 leg, and then 1, 2, 3, 4, and 5 there. So this could be a possible A, B, C structure, right? But making as the look of a running flat. It has the look of a running flat, or it can be an expanding flat, right? What do we see here? The market has just gone up in 1, 2, 3 waves. So it was not an impulse, it's a 3-wave move, okay? Does this C leg retrace at 0.618%? Let's find out. We have A, B there and C. All right, right at the 0.618%, right at the 0.618% is like magic, right at the 0.618%. Okay. But though if I was taking this trade from the blue box, it was probably gonna take me out because I normally like to put my stop loss at exactly 1.618%. Okay, because once you find the wave starting to go above 1.618, then you see that it's an impulse and not a corrective wave. But this one so far is just a zigzag correction. My expectation is that from the current price levels, the market is just going to drop this massive drop here, equal to this 1, 2, 3, right? We should also have another 1, 2, 3. Okay, so if you are to measure, if you are to forecast this, if we are to forecast this move right here, we would typically anticipate our take profit area to be at that level there. So this would be the typical take profit area. You want to take your profit around that price for a sell. So selling at current price levels, your stop loss would be here, right? So this is an entry. That's your stop loss. That's your stop loss. This trade can be executed right now. It can be executed right now because the structure is a textbook structure, textbook WXY, textbook WX, and we are trading the Y leg. Okay, we are trading the Y leg. We know that typically the Y leg should come between the 1 and the 1.382%, but in any case, it should not come to this level here. So this is just a small move to the downside, right? But overall, we know that at the end of this WXY, what is the market gonna do? So this was a small blue box just to buy into, but this trade here, okay, so while you are running that small trade to the downside, you have your buy limit here. And you have your stop loss there. Now this is going to be more rewarding. This is going to be more rewarding. This is just a short sell, but that is going to be more rewarding. Okay, that's all I had for you today, guys. Until next time, please trade responsibly. Cheers and bye-bye.